Bitcoin is not an inflation hedge. Inflation is complicated. Even people who spend their entire lives studying economics struggle to predict inflation because economics is not a hard science. Anything dependent on the actions of people will have some degree of uncertainty. People are not machines. Even the perception of inflation changes behavior and can develop into a self-fulfilling prophecy. If I want to buy something and I know the price will go up in a few weeks, I will buy it now. Shifting demand forwards will make inflation worse. And even members of the Federal Reserve have developed a shocking amount of humility by admitting their models are less than accurate.
Our expectation is that these high inflation readings that we're seeing now will start to abate, and that's what we think, and it'll be like the lumber experience and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors in the most recent CPI report that went up a lot. We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot.
Many economists were persuaded by the argument that early signs of inflation were transitory as people returned to work and production resumed following unprecedented COVID-related shutdowns. And I'm sure some percentage of price increases were in fact caused by supply constraints and other bottlenecks in the supply chain, like a war in Europe. But it turns out, probably not most of them. Inflation is at its most fundamental level an imbalance in the total amount of demand in an economy and its capacity to fulfill it. In shorthand, often described as too much money chasing too few goods, either because people have too much money or the economy produces too few goods, or a combination of both. In any case, the end result is people bidding up prices, and the solution is either to stop them from bidding up prices or make more stuff. Since making more stuff is hard and rarely feasible in the short term, it takes a long time to grow more food, build a factory, train new workers, assuming you can even source materials and recruit people. The more common policy remedy is to reduce demand, i.e. governments spend less and central banks raise interest rates to reduce the flow of dollars in the economy.
What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
If you spend more money servicing your debt, you will spend less money on restaurants, movies, and refrigerators. Less demand, lower prices, or at least a slower increase in prices. And paying off debts literally destroys money. That money is removed from circulation. A hedge is a position you take to reduce risk in an investment portfolio. If I have a bunch of investments that will suffer from inflation, I might buy an investment that will benefit from inflation just in case. I might hedge my bets. The existence of inflation does not mean all prices go up uniformly across the economy. Just because the consumer price index is showing prices went up 8%, doesn't mean eggs and cars both went up exactly 8%. If you airdrop $1 billion into an economy, people wouldn't spend the money uniformly across all goods and services, and the ability to meet any demand surges also won't be uniform across all goods and services. Therefore, price pressures won't be uniform across all goods and services. More dollars doesn't always mean higher prices everywhere. It's just not that simple. In the case of Bitcoin, that means simply pointing out the number of dollars circulating in the economy has gone up does not mean people will choose to spend those dollars buying Bitcoin. Arguing the supply of Bitcoin will increase more slowly than the supply of dollars provides absolutely no insight into the demand side of the equation. We already established that people can be unpredictable. The best inflation hedge is income from sources with pricing power. That means income that will increase along with inflation. So as your costs go up, so do your earnings. But because human behavior can be so unpredictable, you want them to be linked. You want your earnings to go up at least as fast as your costs, so inflation doesn't really affect your life too much. The entire argument in favor of Bitcoin as an inflation hedge rests on its limited supply, but the supply of many things went up more slowly than dollars. Simply ignoring that fact and repeating the statement that Bitcoin is an inflation hedge does not make it true. Bitcoin is not a hedge against price increases because it is uncorrelated to any prices in the real economy. It is not anchored to anything real on either the demand side nor the supply side. The supply doesn't grow more slowly when energy prices go up. The demand doesn't fluctuate with economic activity. Bitcoin is entirely discretionary. Nobody needs Bitcoin. It's purely speculative. The supply of Bitcoin could grow 0% for the next 10 years, and if nobody finds it useful for any purpose, it wouldn't matter. The price could still go down. Having a limited supply of something doesn't make it useful or give it value in of itself. Bitcoin produces nothing and has no income. Where is the value in that? It is entirely a play on human psychology and the madness of crowds. Yes, it is possible to bet on human psychology and win. Maybe all that money sloshing around will find its way into crypto or Beanie Babies. You might get lucky, but luck is not an investment strategy. Luck isn't a hedge. Luck often requires timing because money can slosh out of something as quickly as it sloshes in. If you really want to speculate, at least choose something with real utility, something anchored to reality. Choose something with a price floor, so if you get it wrong, you won't lose everything. Companies have assets and earnings. Commodities will be consumed. Regardless of what happens to the price of your house, you still have a house. You often hear people say things like uncorrelated risk-adjusted hedge for whatever. That's just a fancy way of saying they picked a number and spun the roulette wheel. There is no link to anything real, so there can't be a hedge against something real. They are just playing a game. If you found this content helpful, please consider liking the video and subscribing to my channel. It really does help get this channel more exposure and keep me motivated to produce more content.